What's going on, everybody? Welcome into another segment of Live News Review. Now, this is something new that I'm going to start doing. You'll sometimes see me do things like this in terms of what I do on a live, but I need to switch it up. If I'm being honest, I need to switch it up. I feel like my content has gotten very monotonous over the last couple of months. And so we're going to switch it up. We're going to try to make it a little bit more lighthearted in some instances, but in other instances, talk about some of the serious stuff. So in all of these segments, we are going to have just a weekly news review. All of the news that has something to do with real estate, we're going to talk about. We're going to break it down. I'm going to give my opinion, and then we're going to chop that up, make it into short form content. And so there's a lot of stuff going on right now that affects rates, that affects housing, that affects mortgages. So I want to get into all of that. So let's just jump right into it. If I'm being completely honest with you, I'd rather just get right into it right now because, again, a lot to cover. So first of all, there's this question about interest rates. Okay. Are interest rates going to fall? Are interest rates going to maintain? What is going to happen? How is it going to happen? And what effect is it going to have? Now, this is something that I do think everybody needs to be aware of. And I want to give a little bit of context into what I think is going to happen and what repercussions it could have on the market in general. Now, we know that affordability is awful. We know that there's a lot of people that have been priced out of the market that simply just cannot buy real estate. Now, we have two phenomenon that are going on at the exact same time that usually you'll see one or the other, but right now we have both. At the same time, we have high interest rates and high prices. Now, what you would sometimes assume is that when rates get high, prices dip substantially. And the reverse is also true. Right? That what causes high prices is low rates. That's conventional wisdom, if you will. But right now, that's not what we're seeing. We're seeing actually the complete opposite. And we're seeing a situation where at the same time, we have low inventory, high rates, and high prices. So that causes massive issues when it comes to affordability. It destroys affordability. So how do you fix it? The question is, how do you fix it? There are only two ways that you can fix it. And this is just in general. Whenever you have an affordability issue, there are two ways that you can fix it. Number one, you can drop the price, obviously. You can drop the price, things get more affordable, you're good. The other way, in this particular case, is to drop the interest rates. Okay, now, the question is, which of the two should happen? If you want to fix affordability or you have to fix affordability, you have to take one of these two paths. You're either going to drop the rates or you're going to drop the prices. Which one should you choose? And that's the big question. Now, here's my opinion on this matter. When it comes to which one, I don't want to say should be chosen. I'm going to say will most likely be chosen. We have a president, and I talked about this the other day on TikTok Live, but we have a president that regardless of what you think of him, it doesn't matter if you're a Republican or a Democrat, it doesn't matter. I'm simply talking about the man, Donald Trump. And what I'm going to share with you isn't even exactly specific to Donald Trump. I think this is something that any politician would agree with in terms of politicians. If there's one thing they don't like, it's to be blamed for negative outcomes. Can we agree? Politicians don't like to be blamed for negative outcomes. So what is the potential negative outcome? The potential negative outcome is that home values decrease. And so when you look at a story like this of Trump stepping up this pressure to get Powell to drop rates, I'm actually going to show you the note, which is insane. Why is he doing that? What is behind this pressure to ease rates? The reason is because he wants to avoid a market crash. He wants to avoid a market crash. Now, there are going to be people out there that are going to say, no, the market actually needs to reset. It needs to get more affordable. It needs to drop. It needs to change. But when you look at it from his perspective, if you will, if you look at statistics, a large percentage of Republican voters are homeowners. A large percentage of Republican voters are homeowners. And so when you have an asset, when you own a property, and the value of that property decreases, you could make the argument that the homeowner is losing money. Do we agree? The homeowner's losing money because my home now isn't worth 500,000. Now it's worth 450,000. So I'm losing money. This administration does not want that to happen. They just don't. They don't want that to happen. That is a very negative outcome in their minds if all of a sudden home values start to decrease. So the only other alternative is to drop the rates, because the affordability issue has to be solved somehow, which is why you see stories like this of Trump ramping up the pressure to get Jerome Powell to drop the rates. Is he going to be successful? I think so. Because you have an administration that, again, this isn't just this administration. I think most administrations around the world are most likely going to be more concerned about the short term than the long term. So when you see midterms coming up, when you start forecasting to the 2028 election, the one thing that the Republican Party does not want is for voters to go to the polls and think, I voted for this ticket last time and I lost money. My assets decreased in value. I lost wealth. They don't want that. They want the reverse. Rates come down, prices go up, but if you're a homeowner, now your home is more valuable. So you made money, if that makes sense. Not only did you make money, but now if my home goes from being worth 500,000 to 550,000, I can use that money. I can take out a HELOC, I can refinance, cash out, reinvest that money. It gets the economy moving again. That's the goal. That's what they want to accomplish, for prices to go up. Now, the counter argument to that is, okay, great, but if you do that, what happens to inflation? What happens to inflation? And that's the thing that I don't think this administration particularly cares about. And when you see this note, it's all about the Federal Reserve rate. They want to drop that Federal Reserve rate. Now, this note is hilarious. Okay. So first of all, I have to say, if that is Donald Trump's real handwriting, which I think it is, that is gorgeous. Can I just say that? That is an awesome handwriting. And by the way, what is going on with his signature? His signature is insane, by the way. But anyway, this is a chart of all of these other countries and how much they are paying in terms of a federal funds rate, whatever the equivalent is for them. You look at Switzerland, Cambodia, Japan, Denmark, Thailand. So he says we should be right here, which is at right about 1% in terms of a federal funds rate. Now, what is the federal funds rate right now? We are at about 4.5%. So he sends Jerome Powell this note and it says, you are, as usual, too late. You have cost the U.S. a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars being lost, no inflation. And he signs it. So we're down here 4.5. Donald Trump wants us to be up here with Japan and Denmark around the 1% rate in terms of the federal funds rate. That is very aggressive, my friends. That is insanely aggressive. Insanely aggressive. Okay. Now, what would that mean for mortgage rates? Now, it's true that there is no perfect correlation. So you can't say, oh, if the funds rate is 1%, then mortgage rates are 2% higher. That's not how it works. There is no perfect correlation. But if history is any indication and the current situation is any indication, usually the mortgage rates are going to be about 2% higher-ish. Again, not a perfect correlation, not exactly. Don't take this as a golden rule, but about 2% higher in terms of mortgage rates. So let's run this math. After the pandemic, everybody, including myself, said, I don't think we'll ever see 3% mortgage rates again. I said it. Go back to my videos. I said it multiple times. If this becomes true and the federal funds rate goes to 1%, we could very easily see a situation where mortgage rates dip to 3%. And again, that's the choice that is being made. What happens if rates go down to 3%? Prices are going to skyrocket, but homeowners are going to feel like they're making money. That's the argument. The counter argument is, what does that do to inflation? Inflation goes through the roof. Again, I don't think this administration or any administration particularly cares about the long-term effects after this administration is gone. I think they care more about getting homeowners and individuals some relief in the short term than thinking about the long term. If that is true, then yes, you push to drop the rates because that is going to get the economy moving again. Because the other thing that is happening, and I'm having conversations like this every single day, but we have sellers that I know are Trump supporters, and they're trying to sell their property and it's not selling as fast as they would like, or they've had to drop the price, or they've had to pay a bunch of concessions because interest rates are so high. So buyers are requesting concessions to cover for those fees. Well, they are blaming, whether they're right or wrong. Again, this isn't about right or wrong. This is about what is. They are blaming the administration for not dropping rates, hence putting them in a more difficult situation when it comes to selling. And the sentiment is, if they would drop the rates, I could sell better. I could sell under better terms. I could sell and not have so many expenses. And honestly, I think they're right. I think that's true. I think that's true. So if this happens and we go to 1% federal funds rate, that is going to be insane. Some might argue that that's too much. Some might argue that that's too aggressive. I don't know. I'm not an economist, but it is incredibly steep. I will say that. So that's number one. And here's where it talks a little bit about that. Trump wants interest rate cuts to 1%. What would that mean for mortgage rates? It would bring it into the 3s and 4s. 3s and 4s. Now, what I have said all the time is just get us into the 5s. Just get us into the 5s. You get us into the 5s, we will do the rest. 3s, low 4s, there you are going to see a market frenzy. So again, it just kind of depends what side of the argument you're on. If you think that's a good thing, if you think that's a bad thing, I think it just is what it is. And I think when having to choose between dipping prices or values and dipping rates, I think they're going to go for dipping rates all day long. All day long. So very interesting note here. Next up, Berkshire Hathaway predicts mortgage rate changes will stir the housing market. Now, this part is interesting because there are some assumptions that are being made. There are some assumptions about the housing market that are being made. And the assumptions are, number one, that if rates dip, then the market will automatically frenzy. I think to some degree that would be true, at least seeing here the Utah market. If rates were to get that low or just dip at all, then you would have a lot more activity. What Berkshire Hathaway predicts is that even if rates drop, people are still going to be timid. People are still going to not jump into the market 100%. People are going to wait it out, which is a very interesting take on this whole situation. I don't know that I agree with it because I do think that there's so much pent-up demand, especially here in Utah. You're still seeing properties being sold. And so if all of a sudden rates go to 4%, certainly 3%, I think you are going to see an influx of activity. But I wanted to share this because I do think that it's an interesting take on the market at large. Again, they predict that even if rates start to drop, people are still going to be tentative. There's not going to be that much activity, and we're not going to see the absolute boom. I disagree. I think you are still going to see the absolute boom, especially if rates get into the 3s. But I do think that it's an interesting take on this whole situation. And last of all, the last story that I wanted to share, you guys may have seen this, but Fannie and Freddie Mac ordered to consider crypto as an asset when buying mortgages. This is a big deal. And I think that this points to the larger premise of the market is trying to find ways to rally itself up. It's trying to find ways to come back, if you will. And that's just what capitalism does. Honestly, that's just what the market does. The market is always going to try to find ways to incentivize consumption. The market is always going to try to find ways to incentivize consumption. And so when you're in a situation where people aren't being able to qualify for whatever reason, people take a step back and they say, okay, what can we do to make it easier for people to buy real estate because that injects money into the system. Well, crypto is an example of that. Crypto is an example of that. Now, the interesting thing about this situation is that the crypto assets will have to be held in a government regulated place, exchange. So depending on where you hold your crypto, you might have to move it, which might have some implications. But the point is, they're now going to count it, consider it as part of your assets to qualify for mortgage, which previously was not the case. Now, the other thing is, it's going to be counted as an asset. You don't even have to sell it. You don't have to sell it. It's just there. It becomes similar to stocks and bonds. You hold those have a certain value, and it can be counted towards a mortgage pre-approval. That is significant. That is significant because now you're going to have people that have money invested into cryptocurrencies that previously, unless they liquidated it, would not be able to use it to be able to qualify. Now they're going to be able to use it to qualify. And so again, the punchline is the market is going to try to find ways to incentivize movement. The market is going to try to find ways to incentivize movement, whether it's through dipping the rates, whether it's through, for example, builder incentives, which we've talked about ad nauseum on the show, builders giving 6% concessions, dropping prices, paying for buy downs. You see a lot of those activities to try to generate activity. This is no different. This is no different. So if Fannie and Freddie are now going to consider crypto as an asset when buying mortgages, that is a big deal. I do think that is a big deal. That is going to make a massive difference for a lot of individuals. So you're starting to see the evolution of real estate, at least in the short term. So a couple of things that you should remember. Number one, if rates drop, I believe, I don't agree with the Berkshire Hathaway prediction. I think if rates drop the way that they are attempting to drop them, you are going to see an influx of activity. So what does that mean? If you're a buyer right now, and you can afford to purchase the property and you can get all of these incentives, if you can negotiate more buyer-friendly deals, do so now. And the reason for that is because if the frenzy materializes, then you're not going to see as much leeway in terms of negotiations when it comes to incentives, closing costs, buy downs, and things of that nature. Now, you might say, I'm not going to need the buy down if the interest rate is 4%. Fair. But even then, you're still going to have closing costs. Every mortgage has closing costs. And so right now, you're in a position where it's easier to negotiate closing cost assistance for a buyer than it will be when the market gets more competitive. When the market gets more competitive and now you're in multiple offer situations, which by the way, is not completely uncommon in today's market. It's rare, but it's not completely uncommon. You're still seeing some properties have multiple offers. Some are sitting, that is true, but others that are well priced, where the seller has enough equity to be aggressive, those kinds of properties are still selling very, very quickly. And so we have evidence here in our office and just in general that when you're in a multiple offer situation, the first thing that's going to go are these concessions. Buyers are going to have to pay for their own closing costs. So if you're a buyer right now that doesn't have a ton of money, maybe you can cover your down payment, but that's it. You don't have a bunch of extra money, then you would be wise to purchase right now. You just would. You would be wise to purchase right now because right now you're going to be able to get all of these other incentives that you otherwise would not be able to get. And so it's important that you take that into consideration. It's super important that you take that into consideration. Let me see, make sure the stream is good over here. Good. So that is going to make a huge difference. It's going to make a difference. Now, if you're a buyer that does have some extra money, if you're a buyer that does have, I don't know, whatever it is, if you needed to pay for your own closing costs, you could pay for your own closing costs. If that is you, then maybe you could wait for a lower interest rate, it is going to help your monthly payment. But here's where I think that you need to beware, be cautious. It very well might be that even if you get lower rates, because this is going to cause prices to go up, that benefit might cancel out. Does that make sense? Because if right now, and this is all going to be subjective on the math and the specific property, but let's say you could buy a property right now for $500,000 at 6% interest. Okay, great. It very well might be that if the rate drops to 5%, now you're going to have to buy that property at 550 or 560. And so in terms of monthly payment savings, in terms of affordability, it doesn't really solve the issue. It doesn't, because prices are going to go up. So it's going to be almost just as expensive, if not more so, what you're going to have to pay. And so here's the interesting portion. Here's the other side of that argument. When somebody says, okay, you can change an interest rate, but you can't change a purchase price. You can change an interest rate, but you can't change a purchase price. And so what game do you want to play? At the end of the day, that's what it's all about. What game do you want to play? What game do you want to play? Now, if you're a seller and you have to sell, then great, you have to sell. Like, I don't know what else to tell you. You have to sell. You have to be mindful of the market that you're in. Listen to your agent. Hopefully your agent is smart. Listen to your agent so that they can guide you through this whole thing. Don't make the mistake of starting high and then trying to drop it over time. At the end of the day, it's your house. You're going to do what you want, but beware the aspirational pricing strategy. Beware the aspirational pricing strategy. The aspirational pricing strategy is you're going to list high as aspirational. You're hoping for something. You list high, you hope that something happens. And if and when it doesn't, then you drop down slowly. Drop. Do not do that. Do not do that. That is one of the reasons why properties are sitting. Be realistic about your price. Look at the comps. Be objective and understand that if there's a comp, you might want to be a little bit under that, 2-3% below the comp to be able to generate activity. And also, don't make the mistake of assuming that when you're dropping the price that you're losing money, especially if you go aspirational. If the comps say 500 and you list for 550 and all of a sudden you're having to drop that price, you never had the 550 to begin with. And that's the big mistake the sellers are making. Comps say 500. They list at 550. Nothing happens for a month. Agent says we need to drop the price to 525. Great, drop the price to 525. The seller feels like they lost $25,000. You did not. You did not lose $25,000. You never had that money to begin with. So these are some of these mindset shifts that we have to make as sellers to not fall into this trap. Do not fall into this trap, because it'll take longer to sell your property. You're going to end up being frustrated. You're going to think it's your agent that isn't a good marketer. You're going to think that your agent is this, your agent is that, and you're going to agent hop, and you're going to realize that in most cases, it wasn't the agent at all. It was your price. So be objective when it comes to your price. If you don't have to sell, maybe hold off a little bit. If you don't have to sell, maybe hold off. Now, I share that with a massive caveat. Because if you are a seller and you say, okay, I don't have to sell right now, so I'm going to wait. I'm going to wait for this to happen. I'm going to wait for rates to drop because that is going to bring more activity. So I'm going to be able to have a more favorable sale and I won't have to pay so much in fees. Correct. You're correct about that. But at the same time, though, if you need to buy the next property, that's where it becomes complicated. Okay, because yes, you're going to sell for more, but you're also going to buy for more. Yes, you're going to save on concessions, but then you're going to have to pay concessions on the purchase, if that makes sense. So if I do this, then okay, when I sell, the offers are going to be more aggressive. I'm going to get better offers. And that is true. You're going to get better offers. You're likely not going to have to pay for closing costs. You're going to get a higher price. It's going to work out better for you as a seller if you hold off a couple of months. But Those savings, again, sometimes cancel out because when you turn around and go buy, now you're going to have to compete because it's the same market. In most cases, you're going to transact in the same market. And it's very different when you're in a hot market going from a seller to a buyer, because you go from having all the leverage as a seller to very little leverage as a buyer. And that's difficult for people to consolidate. It's difficult for people to consolidate. It feels awesome being a seller in a seller's market. It feels awesome. But you sell it, great, you crush it, did great, everybody's happy. Then you turn around to buy and it's a totally different story. Because now you're not going to get the help in closing costs. Now you're in your buyer's shoes. So you have to get aggressive. You might have to overpay a little bit. You might have to pay for your own closing costs. You're going to have to do all of these things. And so it's not as clear cut as just simply saying, yeah, I'm going to wait. And it's going to be better, 100% better if I wait. It depends. And that's the hard thing about this whole real estate thing, that the answer is often, it depends. The answer is often, it depends. So this may very well happen. I think it's going to happen. If I'm being honest with you, I don't know if it's going to go down to 1%, but I do think that it's going to go down. Now, Morgan Stanley predicted the federal funds rate would go to 2.5% by the end of 2026. I think that's more reasonable. Trump, and honestly, I think that this is one of those comments. If you ever read Art of the Deal, it's textbook Donald Trump. He's going to push for 1% to eventually end up at 2.5. It's just the way it goes. Negotiation tactic 101. He's pushing for 1. He says, I want 1. In the back of his mind, he's like, if I can at least get 2.5 on the funds rate, that will solve a lot of the issues. I think that's what's at play here. I think 1% is way too aggressive. Even when you look at these other countries that we're comparing with, Switzerland, Cambodia, Japan, Denmark, we are not them. Okay, we are not them. This is a different ballgame. But I do think something in the 2s is, I don't know if it's reasonable, but I think it is predictable. I think that is what could happen. All right. So hope that was helpful, guys. I'm going to be doing more of these live news reviews, just with stories, what is happening, what is going on in the market. We'll try to make it fun. We'll try to make it light. We'll try to, make it engaging for you guys. So with that being said, see you guys later.